Want to get back to the broader action market and the sell-off that's underway. Joining me now with more is Bob Iaccino. He's founder and chief strategist at Path Trading Partners. And he joins me from the CME Group in Chicago. Bob, it's great to see you. Talk to me a little bit about sentiment. You know, the market went from really kind of putting aside these trade worries, chalking it up to rhetoric, to now really seems to be reacting. Why the change? What's going on?
Well, I think it's a direct result of two things, Maggie. Number one, obviously, President Trump asking the Commerce Department to look at another $200 billion in Chinese tariffs or products that would get an additional 10% tariff, I should say. And then he also made the statement that if China retaliates to that, we'll look at another $200 billion. And it's just impossible to avoid prices rising at a consumer level when you get to those kinds of numbers. The initial numbers weren't necessarily that significant when you look at the broader market, the size of GDP of the two countries, but now you get that. The second thing is at the Sintra conference, the Central Bankers Conference in Portugal, Mario Draghi in his opening statements doubled down on the dovish statements that he made in the press conference after the ECB meeting, which is driving the dollar up. So not only will we get tariff increases in prices, but we'll get the currency adjustment increases in prices as well. That's why you're seeing the Dow be down the most. NASDAQ is actually second, only a few points above of the loss on the S&P, and the Russell actually doing the best because of the domestic profits mostly that come into the Russell 2000. So that's where you're seeing that relationship sort of take hold, and that's why we know it's these factors.
That's really important, and I'm glad you brought up currencies. We don't talk about it all the time, but that has been a move that's underway. Do you expect the dollar to continue to strengthen under these circumstances? And you know, we know profits were, what, 20%, U.S. economy strong. Is there not enough cushion for corporations to absorb that?
Well, there is, but you'll probably get a little bit of a hit to profit in this upcoming earnings season. We're about 2 weeks out from the official start. But then if this were to continue, which is what the rhetoric is now, and we know that President Trump can stop and spin on a dime like he did with North Korea, which arguably could be a much more serious circumstance, he can flip on a dime with this as well. And I think that's why we're not seeing a more comprehensive sell-off. And yes, the flight to quality goes into the U.S. dollar simply because the engine of any growth at all is commodities. The dollar is relatable to commodities in terms of the inverse relationship. So I expect the dollar to continue to strengthen. Countries need to buy the dollar to buy their commodities.
Yeah, you're right. And you're right about the sell-off. We dropped that 300 and we're just sitting there. You know, it's like these little messages going out to politicians to be careful, and everyone kind of holding on to see if there is any change in policy. Bob, what about bonds? We saw money also moving into U.S. bonds, but I know people feel, you know, a little uncomfortable or unsure about that allocation given where we are with everything else.
Well, again, hopefully that's short term because that's a negative for especially the U.S. economy. We've seen a flattening of the yield curve, 2s to 10s, from about 43 prior to the Fed meeting, all the way down below 36, 35 now, which will start to get people thinking that an economic slowdown is coming. People should remember the longer term rates show inflation and growth. The shorter term rates really are reliant upon the Fed, who also doubled down by upping the dot plots from predicting 3 rate hikes for 2018, 2 of which are done, to 4. Now, Bostic came out yesterday, said he's still at 3, so he seemed like he tried to walk that back. We'll see. We've got a lot of Fed speakers in this conference. So again, it goes to a global slowdown in the course of lower long-term rates, higher short-term rates, and that's going to offset any stimulus we could get from the corporate tax cuts, which honestly we haven't seen yet.
Yeah, all really good stuff, and really important to explain, Bob, to our viewers how all these different markets tie in together, and we appreciate that. Always good to catch up with you. Thank you so much.
Good to see you.